Hi guys, now we look at bonds payable. Bonds payable is a form of interest-bearing notes payable issued by the company, the corporations, the university, and the government's agency. When a corporations issued bonds, means that they borrowing money. Okay, the person who buys the bonds, or we call the bonds holder, is the person who investing in the bonds. Now, this is the way to record the journal entry to record the issuance of bonds at face value. We shall debit bank and credit bonds payable. So explanation will be to record issuance of bonds. To record payment of interest expenses during current accounting period, we shall debit interest expenses, credit bank, and explanation will be to record interest expense. To record the adjustment of accrued interest expenses or interest payable, we shall debit interest expense, credit interest payable. So explanation will be to record the accrued interest. To record interest payment and bond redemption on maturity, we shall debit interest payable and credit bank. The explanation will be to record the interest payment. Then we debit bond payable and credit bank. So explanation will be to record redemption of bonds at maturity date. So this is the way the presentation of liabilities in a statement of financial positions. Okay, so for non-current liabilities, we have long-term notes payable, mortgage payable, bonds payable, then you get your total non-current liability. For the current liabilities, we have account payable, notes payable, warranty payables, expenses payable, unearned revenues, and you got your total of current liabilities. So you add up the total of non-current liabilities and total of current liabilities, you get your total liabilities. Now look at your example H in your tutorial book. This is about the bonds payable. Okay, Warisan Nusantara Berhad is allowed to issue 40,000 unit bonds AA 6%, par value of 1,000 per unit and maturity in 5 years, and 10,000 units bond BB 8%, par value of 1,000 per unit and maturity in 10 years. Okay, additional informations about bond AA is bond 6%, par value 1,000 per unit, totaling 20 millions, issued on May 1st, 2009. And bond BB will be bond 8%, par value 1,000 per unit, totaling 5 million, issued on July 1st, 2009. So the question is to prepare the journal entry to record the issued bond and show the positions in a statement of financial positions on December 31st, 2009. Now we look at the way to do this bond payable. Now, as I said, before you do anything, you may write down all the information about the questions. Okay, about bond AA, this is bond 6%, totaling 20 million, issued on 1st May 2009. About bond BB is bond 8%, totaling of 5 millions, issued on 1st July 2009. So everything, before you do anything, you must know the accounting period. The accounting period is on 1st January until 31st December. Now, step 1, to record the issuance of bonds at face value. So, On 1st May 2009, we debit bank 20 millions and we credit bonds AA 6%, 20 millions. Okay, we have two ways to write the name of the bonds. Either bond AA, comma 6% or 6%, comma bond AA. It's up to you. But this is the way that I write. Okay, now explanation will be to record the issuance of bonds. On 1st July 2009, we debit bank 5 million and we credit 8% bond BB 5 million. So the explanation will be to record the issuance of bonds. Well, to answer the second question in example H, to present the liabilities in statement at financial positions, this is the way. Okay, now you can write there non-current liabilities, bond payable AA, comma 6%, 20 millions, and bond payable BB, comma 8%, 5 million, and this is a total 25 million. Now look at example I. Based on the example H, Warisan Nusantara Berhad paid the interest twice a year, which is every 6 months to the bondholder. So question is to prepare the journal entry to record the interest payment for both types of bonds that has been published. For example I, we will do a second step to record the interest expense payable during current accounting period, and third step to record adjustment of accrued interest expense or interest payable. So before that, we need to draw a timeline. Okay, we do it one by one. For bond AA is bond 6% and totaling 20 millions. So we draw a timeline just like this. Okay, this is the beginning of accounting period until the end of accounting period, and this is the issuance of the bond AA 1st May on 2009. Okay, after 6 months on 31st October. Okay, under this date we will need to do the payment of interest. Okay, now then after that, from 31st October until 31st December, okay, this is only 2 months. That's why we need to do the adjustment for the interest payable. So here we will count for the interest payable at the end of accounting period. On 31st October 2009, we shall debit interest expense 600,000 and credit bank 600,000. Okay, how do I get this amount? This is the 6% times 20 millions times 6 months. As you see here, from 1st May until 31st October is only 6 months. That's why we times 6 months. Okay, so explanation will be to record the interest expense of bond AA. On 31st December, so we will need to record the interest payable. So on 31st December 2009, we will need to do the adjustment. We debit interest expense 200,000 and credit interest payable 200,000. So how do I get the 200,000? This is the calculation. Remember, write down the calculation here to show you know how to do it. And this calculation has mark. Okay, so 6% times 20 millions times 2 months. So we got 200,000. So explanation will be to record the interest payable of bond AA. Okay, the interest payable is considered a current liability. Well, for bond BB, this is the bond 8% and totaling 5 million. So the first step is to draw a timeline. Okay, starting accounting period 1st January 2009 until the end of accounting period 31st December 2009. So the bond BB issued on 1st July 2009. Okay, so until the end of accounting period is 6 months. So here we will need to do the interest payment. So this is the way to record the journal entry. On 31st December 2009, we shall debit interest expense 200,000 and credit bank 200,000. How do I calculate this one? Because this is the bond of 8%. So 8% times 5 millions times 6 months. That's why you got 200,000. Okay, so now look at the explanations to record the interest expense of bond BB. Okay, example J. Based on the example H, Warisan Nusantara Berhad wants to redeem bond AA by paying cash. Underline that. Redeem bond AA by paying cash on the maturity date. So question is, show the journal entry to record the transaction. Example J, we will do the step 4 to record the interest payment and bond redemption on maturity date. So before we do anything, write down the information about the bond AA. Bond AA is bond 6%, totaling 20 million, issued on 1st May 2009, maturing in 5 years, interest payment every 6 months. Okay, next step will be to find out the maturity date for bond AA. Okay, now we know that the issued date is 1st May 2009. So 1st May 2009 until 30 April 2010 is year 1. 1st May 2010 until 30 April 2011 is year 2. 1st May 2011 until 30 April 2012 is year 3. So 1st May 2012 until 30 April 2013, year 4. 1st May 2013 until 30 April 2014 is year 5. So 30 April 2014 is the maturity date. Now, please draw a timeline to help you understand the questions. Okay, to understand the bond AA. Well, this bond AA involved 2 accounting period. Okay, why? Because on year 5 of bond AA, we start on 1st May 2013 and until 30 April 2014. That's why we have involved 2 accounting period. Okay, involved 2 accounting period. Due to the first accounting period start on 1st January, end of 31st December. So at 31st December, we will need to do the adjustment. Okay, so this is the year 5 for the bond AA. Okay, so and involved 2 accounting period. Okay, so okay, now we look at the first one. For the year 5 of bond AA, start on 1st May 2013 until 31st October 2013. This is exactly 6 months. So here you will need to do the interest expenses. Okay, so you already did this one, but at the end of the maturity date on 30 April 2014, we will need to do the redemption. So okay, from 31st October 2013 until 31st December 2013, this is only 2 months. Okay, so we will need to record the interest payable. So from 1st January 2014 until 30 April 2014, this is another 4 months, and so this one will record as interest expense. Okay, so this is the one, the explanations for the whole concept of bond AA. Well, this will be the journal entry for redemptions bond AA by paying cash on maturity date 30 April 2014. So on the maturity date 30 April 2014, we shall debit bond AA payable, or we say bond payable AA 20 millions, then we credit cash 20 millions. So explanation will be to record the redemption of bond AA at maturity. Okay, so beside that, we will need to do the payment, interest payment. So how do we do the interest payment? Is by debit interest payable 200,000. Okay, how do I get the 200,000? Is 6% times 20 millions times 2 months. So I got the interest for 200,000. So for the other one, interest expense, okay, 400,000. So I used 6% times 20 millions times 4 months. So this total is 6 months. Am I right? Because the interest should pay in every 6 months. So by that, the company should credit cash 600,000. So explanation will be to record the interest payment of bond AA.